Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the recent jobs report and how the unemployment rate has risen to 4.3%. Furthermore, we had some revisions to prior months that actually sent, I believe it was the June Nonfarm payrolls negative. So we're going to talk about some of that stuff, what it might do to expectations for the Fed funds rate, etc. We'll probably talk a little bit also about Bitcoin and the stock market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, as I said, the unemployment rate has risen to 4.3%. Obviously, this was always going to be the most likely outcome. We've seen a lot of softening in the labor market in recent months. Basically, if you zoom in, it sort of gets to a level, stays there for a while, and then moves up to a new level. And it looks like we're probably in the process of moving up to a new level for a little while. If you actually apply a moving average, it helps to smooth out some of this stuff. So you can see that the unemployment rate has been sort of steadily going up for a while. But it also hasn't been going up in an uncontrolled way. The rise in the labor market, the weakness in the labor market was engineered, right, by the Federal Reserve. They wanted to loosen up the labor market, and the reason is because they wanted to reduce inflation. And one of the biggest drivers of inflation is wage inflation. And if everyone's getting paid more, then it can lead to just more demand for things, and that can lead to higher prices and so on and so forth. So the unemployment rate right now is sitting at 4.3%. Likely will continue to go up. But when you look at it, when you look at this compared to, say, major moves in the past by the unemployment rate, it isn't, at least not yet, in that parabolic phase where it's going up in a scary manner or an uncontrolled manner, right? Now, with a weak jobs report, it seems highly likely that we will get a rate cut in September. And as we were discussing on NFA Live yesterday, one of the things I was sort of contemplating about is, well, when are traders going to start thinking about a 50 basis point rate cut? Now, I'm not suggesting that a 50 basis point rate cut is necessarily the most likely outcome, and primarily because of the inflation data. I think if you had weak inflation data, a 50 basis point rate cut should be what actually happens. But with the inflation data still there, and still not necessarily dropping, we saw PPI come in pretty hot not too long ago. If you look at the current expectations, there's about an 87% chance the Fed will only cut 25 basis points. Now, what's really interesting is that this probability of a 50 basis point rate cut was essentially at zero in recent days. And I was looking at it kind of puzzled as to why it was zero, considering some of the weakness we might see in the jobs report. Well, now it's gone from zero to about, 10 to 20%, right? Right now it's at 13%. Earlier I saw it at like 16%. It's just kind of moving around. Traders are starting to reassess. And one of the reasons they're reassessing, and they're no longer worried about the Fed just pausing, because there was a chance the Fed was just going to keep rates constant, but I don't think that's the most likely outcome. One of the reasons why I think investors were a little nervous to start thinking about a 50 basis point rate cut, or to become too deterministic about a rate cut, period, was because of inflation. But when you have, it's not just the unemployment rate, right? It's not the unemployment rate that's gone up that's the most concerning thing. I mean, this was always a likely outcome. What's the more concerning thing is, if you go over here, we have this macro dashboard. If you look at total non-farm, it only went up 22K, right? So if you look at total non-farm, only 22,000 increase. But what's more interesting than just the slowdown you're seeing there is the month-over-month change. You can see that June non-farm payroll was actually revised negative. And previously, I don't remember the exact number. It might have been like 14K or something like that. It was around those levels. But now it's actually been revised negative. And when you look at this on a, say, quarter over quarter basis, you can see that it is starting to get dangerously close to being negative on a quarterly basis. If you look at a percentage, in terms of percentage, the last quarter, the unemployment rate, or sorry, the total non-farm payroll only went up about 0.055%. Just to give you a comparison, back in 2021, it was increasing by about 1 to 1.5% each quarter. Now it's down to 0.055%. So this is dangerously close to going negative. And historically, right, it's when it goes negative that you can get slowdowns in the economy. Now, not every negative print always leads to an immediate recession, right? You can see that there's times where it goes negative, but the market still doesn't, that the economy still doesn't slip into a recession. But it is something to keep an eye on. What I more so like to look at is the year over year change, because when that goes negative, it typically does mean that you're in a recession. And I think every single time in this has been tracked, every negative print was associated with a recession on a year over year basis. For us right now, though, we're not at that point. We're still at 0.9%, 0.927%. But this could slowly get away from us if things are not done. And the issue that the Fed has is that they have a dual mandate, right? It's not just trying to solve this issue, but it's also making sure that inflation doesn't come back. And I think the hard part right now is we just saw a pretty big increase in the producer price index not too long ago, right? If you look at this is starting to really get away from us. And I don't know if it's mostly due to tariffs or something else, but that's an issue, right? That's an issue. And I have to imagine that is the reason why they're not gonna, there's not a higher chance of a 50 basis point rate cut. If you were to look at, say, core PCE year over year, it's right now 2.02%. If you look at the price index inflation year over year, it's still at 2.88%. So I'm not really sure what's to be blamed for this rising core PCE, whether it's tariffs or whether it's just we got higher stock prices and that leads to higher, the wealth effect, which leads to higher inflation. Whatever the reason is, we're still not seeing inflation where the Fed would ultimately like to be. And so I have to imagine that is the reason why that there's not a higher probability of a 50 basis point rate cut. Because last September, we actually did get a 50 basis point rate cut, right? Last September, if you guys remember, there was a 50 basis point rate cut. And it was also right after the unemployment rate hit around 4.3% back then. Now, you might notice that it doesn't look like the unemployment rate hit 4.3% back then, but that's what you get with revisions. It did hit 4.3, and then later on it was revised back down to 4.2. So we got a 50 basis point rate cut back then. It seems like you could justify a 50 basis point rate cut. I think that the reason they must not be doing it is because they're worried about inflation. That must be the reason, especially when considering that you have a negative print here for total non-farm back in June. And again, year over year change still is okay percentage-wise, 0.927. But I mean, if this thing starts to roll over up here, that's where it could ultimately become an issue. And there's certain things you can look at, like maybe if you actually look at construction, that I think for me is telling of the broader economy, the broader economy starting to really slow down. If you look at total all employees construction, it hasn't really made any progress for most of 2025, and it's starting to drop a little bit. And looking at a year over year change of that, you can see it just dropped below 1%. It's currently at 0.7%. Just keep in mind, like back in 2022, it was at 4%, right? So this is really starting to drop. And what this does is it sort of lines up with what we've seen happen in prior market cycles for the S&P 500 and also for Bitcoin. There's always a narrative, right? The narrative follows the price. Narrative always follows price. But when you look at Bitcoin, you'll notice that it does tend to top out in post-election years. The end of 2013, the end of 2017, the end of 2021, we're getting close to the end of 2025. So if you're wondering, what could possibly cause lower prices in 2026, right, lower asset prices, to usher in your fairly typical midterm year bear market. You have 2014, 2018, and 2022. If you're wondering what could possibly be responsible for a bear market for crypto in 2026, I mean, the narrative is there, right? I mean, you can see stuff is rolling over. Again, that doesn't mean that prices can't go higher sometime between now and 2026. Normally, we've seen crypto top out in, at least Bitcoin top out in Q4 of the post-election year. But if you're searching for a narrative to justify all of that, you need not look further than the labor market. If you think about it, inflation was the narrative for the 2022 bear market. The other side of the dual mandate for the Fed, the labor market, right? It seems like the labor market could be the narrative that follows a potential bear market in 2026. And not only is this true for Bitcoin, but you can also see for the S&P 500, it goes through a very similar process as well, where it tags the 20-week SMA, 21-week EMA sometime in September, October, or between August and October, I guess, if you go back far enough. But look at 2021, right? The S&P tagged that 20-week SMA before then going into the market cycle top a few months later. In 2017, a very similar thing as well, where the S&P tagged here the 20-week SMA in Q3 before then going into the market cycle top. Now, you could argue, though, that we're getting diminishing returns from that September low, as back in 2017, the S&P rallied 18% after the September low. And then in 2021, the S&P rallied 11 to 12% after it found a low in September. So let's suppose that the S&P does fall down here into the bull market support band by late September, early October. It could help by sort of realizing these diminishing returns and sort of the final rally of the cycle. It might be worth noting where that could sort of leave the S&P before then finding a local top and then potentially getting a correction in early 2026. You can see that, Trump was also president in 2017, and then the S&P got a pretty large correction in early 2018 and then in late 2018. So what are the chances that the S&P does this, drops back to the 21-week EMA by late September, early October, goes into the final market cycle top, and then goes into the pretty typical weakness in the midterm year? A lot of times Bitcoin will sort of make a move before the S&P, and you can already see that Bitcoin already corrected to the 21-week EMA, right? Like, Bitcoin already went there. So who's to say the S&P won't also go there? And if that's the case, then it would find confluence with our expectation that Ethereum goes there as well. And how many times have I talked about that for Ethereum, that the most likely outcome is to tag that 21-week EMA by late September, maybe early October, but I lean towards late September, and then go into whatever the final market cycle top is before we get into that 2026 bear market. It seems like the narrative is there. Now, you will also notice that the 10-year yield is getting sold off today. Guess what? Same exact thing happened last year in early September. Look at this right here. You see this candle right here? This was the rate cut in September of 2024. The very first week of September, the 10-year yield dropped 5%, right? You can see negative 4.99%. It dropped from 3.9 to 3.7%. This week, It's down about 3.6. So what if we just see the 10-year yield sort of fall in to that rate cut and then bounce back up? Kind of writes itself at some point, you know? The thing that I think is more worthwhile to think about right now is the 2-year yield, because the 2-year yield, it's really flirting with breaking down here. It's done the same thing, back in April and in September of 2024. And so I've sort of long been under the assumption that whenever the 2-year yield durably breaks down, cycle's over, right? Cycle will be over whenever the 2-year yield breaks down, because that's actually a weak economy. And you can see there's been a lot of scares. There's been a lot of scares. And the question is this just another scare or not? I would say the best case scenario is we get another rate cut in September, and it allows the markets to, in the short term, be optimistic going into October. Maybe you get one more bounce back up to the bull market support band, but as you get closer to 2026, it just seems like this is more than likely going to start to go down. So watch out for the 2-year yield. Simultaneously, don't be surprised if on that final bounce by the 2-year yield, don't be surprised if the 10-year yield actually goes back up here. As crazy as that sounds, it wouldn't be that surprising. It already rallied, right? Back in 2024 when it rallied from, look at that. It was a 33% move. It's kind of weird to do percentage moves when you're talking about a percentage. But you can just see how big of a move that was. It's not like it'd be that impossible for it to get to that level. So if the 2-year yield does bounce following, potential rate cuts, then it would make sense for the 10-year yield to also bounce. The other thing to remember is that the Fed essentially follows the 2-year yield, right? If you overlay interest rates, here with the Fed funds rate, let's go over to a monthly time frame. The Fed generally follows the 2-year yield. So, the expectation here is with the 2-year yield at 3.5%, it seems likely that sometime by mid 2026, late 2026, that the 2-year yield could very well be, or the Fed funds rate could very well be at 3.5% or lower. You can see in the last several business cycles, right? The 2-year yield falls first, and then the Fed funds rate follows. You see that? The 2-year falls, and then the Fed funds rate follows. That's how it always happens. So the 2 years falling, the Fed funds rate will almost assuredly follow. Okay? Other thing to remember, with this introduced uncertainty, with the labor market starting to weaken, it also lines up perfectly with our expectation that Bitcoin dominance is going to go higher here. So I would watch for dominance to go higher. Last year, right after that first rate cut, a lot of people got really optimistic about dominance dropping. But you can see that alt Bitcoin pairs, they sort of rallied into the rate cut and then they sold off after it, right? So why can't that happen again? I would argue that if you want something more durable to happen for alt Bitcoin pairs, you need the Fed funds rate below the 2-year yield, below the neutral rate, or at least closer to it than it is, because right now it's still pretty far away from it. Again, the 2-year yield is at 3.5%, but the Fed funds rate is basically 100 basis points higher than that. So I would expect, things like ETH, Bitcoin to sort of fall back in for a little bit, maybe form a higher low before then going into the final rally, sort of in the cycle for the ETH Bitcoin pair. There is always a chance that people need to be aware of for Bitcoin. There's always a chance that the top is already in. But what I would look for in terms of that, look for confluence, look for other indicators to fire off, which haven't happened yet. And one of the most trusty, simple indicators for confirmation that the top is in historically is a close below the 50-week SMA, and really 2 closes below the 50-week moving average. So as long as you don't have 2 closes below the 50-week moving average, there is still reason to, for there to be some optimism, right? There's still some reason to be optimistic about that. But for Ethereum, I do think it really is likely that it's going to fall back down here into that 21-week EMA by late September. That would be my expectation. So if you go back over to the jobs report, if we look at a couple other things, you can actually look at the unemployment rate, or sorry, if you go over to total temporary help services, that continues to drop. But there are pockets of things that are good. It's just you have to look really closely. Job openings continues to drop. One of the biggest things I mentioned this on Twitter already. One of the biggest things that Powell will certainly be interested in looking at is the number of openings per unemployed worker, right? So if we go over here and we just add in, job openings, we add that onto the workbench. We have this workbench here where you can add in a lot of macro data, a lot of crypto data, a lot of stock data, etc. Even Forex, like currencies and whatnot. You have job openings, but you can also look here at unemployed, the unemployment level, okay, and add that. And what you want to do is you want to add a metric here to basically look to see how many job openings are there per unemployed worker. So in this case, we'll go to the formula and we'll just type in M1 divided by M2. And you get this. Okay, now let's hide everything else. And what you'll notice is that it's recently dropped below 1, meaning that there's fewer job openings now per unemployed worker. Okay, the reason why I even talk about this is because Powell has referenced it a lot. So he now can no longer say that it's above 1. Now he has to agree that, hey, this has actually gone below 1, and therefore it does certainly justify a rate cut, right? So in this case, if we continue on looking at some of the other things, if you look at, what else did I want to show you guys here? There was, we could look at the recession indicators, but the smooth recession probability indicator is still pretty low. So as of July 2025, the odds that the U.S. economy is in a recession is only 0.8%. So relatively low. If you look at the composite leading indicator, it looked like it was starting to curl over here, and then it just started to go back up again. So the coincident economic activity index continues to go higher. The year-over-year change still looks okay for now. Like, it still looks okay. I don't really think we're in recession territory until initial claims are printing 300K plus. And this is one of those things that, and I've said it for years now, it'd be easy to constantly call for it to go above 300K. You would have been much better off just being like, look, let's not try to predict when it's going to happen. Let's just, whenever it does happen, we'll take note. I don't edit my videos, so you'll get to hear that too. If we look at a couple other things, let's actually go over to the dashboard because there's some other stuff that came in today as well. Let's go look at the unemployment level, I want to look at hours. Average hours worked per week, 34.2, right? So it hasn't really changed a whole lot in a few months. Hires are down. Layoffs are not really that much higher. They're a little higher, I think, but not a lot. Hires went up a little bit, but still relatively low. Still just suggesting there's not a lot of people hiring. So then a lot of people think that means that there's a ton of layoffs, but really, layoffs, all things considered, are still basically where they were from like 2011 until 2019, right? They're not that high. So that's the reason why the unemployment rate is so low, and one of the reasons why the stock market, has remained at all-time highs is because, look, yeah, we see the unemployment rate is slowly going higher, but it's mostly due to new entrants to the labor force not being able to find a job rather than people getting laid off. Because again, if you go look at the unemployment level for 16 to 19-year-olds, it's a lot higher, right? Look at the unemployment rate for everyone is 4.3%. But for 16 to 19-year-olds, it's 13.9%, right? This is what's going up. And also, I imagine it's somewhat high for maybe 20 to 24-year-olds. Yeah, so that had a big jump this month, and it just rallied from 7.9 to 9.2%. So where the economy is hurting people the most right now are younger people, like out of high school or even in high school, or right out of college, they're having a harder time finding a job. And that's why the unemployment rate is mostly going up. Because if you look at just say 25 to 54-year-olds, that actually is still lower than where it was last year, right? And you could argue that one of the biggest, the people that contribute the most to the stock market are, people that are established or, contributing their 401ks. That affects the stock market a lot more than someone in high school or someone right out of college. So if you think about it like that, it makes sense why stocks have held on. Because you're not really seeing that same increase in like that core group of people that's contributing, to their 401ks. And if you look at the unemployment rate for people older than 55, I mean, that's at 2.9%. It's still relatively low. So again, this is a case of younger people are getting hit really hard right now. So if you're between the ages, let's say you're, somewhere between the ages like 18 to 24, and you're sitting here wondering how the stock market is screaming higher. You're wondering, why does it feel like you're in this is a recession, you can't find a job. You're not going crazy, right? Like there's some validity to your statement. There's not a lot of job openings compared to, what it was a few years ago. And it's really hard to find a job right now based on the macro data. The people that have a job for years have felt fairly secure in those jobs, because layoffs, while there are headlines of some big layoffs, again, it's been a great narrative. There's a lot of headlines, but layoffs still have not really picked up. They probably will in 2026, right? Going into 2026, it'd be a way for the market to top out, and then have a downturn in 2026, similar to 2022, similar to 2018. But the narrative follows the price, not the other way around, and you don't really have to look that hard at a potential narrative for next year. So what I think is the most likely outcome here, I think that the S&P 500 will likely fall back in to its bull market support band within the next, let's call it 4 to 6 weeks, and then that will set up a bounce off of that level. But that's what I think. And it could just simply mean going back here, right? Like going back there to 6,200 or so, and then getting a bounce off of that. Same idea for Ethereum, right? Going back to where it was right here in early August by late September, and then bouncing off of that, and then potentially going back up into a market cycle top. But those are my thoughts about the labor market and about how it could affect things overall in risk assets. And then furthermore, I've been pretty bullish on gold and silver here. I mean, gold's almost at 3,600. Silver is near $41. I would still remain bullish on those through the end of the year. Those will get a correction more than likely in 2026, but I still think there's plenty of further upside for both gold and silver before the year is over, even if they're also subject to a potential correction before a local top where they consolidate. I think silver will probably go up to about $50 before the rally really is over for a while, and it might spend at least a couple of years consolidating between say $30 and $50. But those are my views. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.